Today we're going to have a very interesting webinar, but basically because we know gold has appreciated by as much as 18% since the beginning of the year to break the US dollar 1800 per ounce psychological level, of course. This precious metal has always been a store of value since the Incas. But since the beginning of this millennia, its popularity has again seen as resurgence. So this evening, we're going to talk about merits and the issues of investing in gold, and of course, ask the all-important question, is gold a wealth preservation tool? To help us answer this question, we have Robin Lee, CEO and co-founder of HelloGold, and Rajen Devadason, certified financial planner and CEO of our WealthCreation, who'll be joining us together with the one and only Malek, founder of filife and BFM. Good evening, gentlemen.
Good evening, Sterling.
Good evening.
Let's jump to the first question, and this is direct, Robin. Tell me what's so good about gold? Why should it be one of my must-have asset classes today?
Well, I think first off, if you think about the traditional holders of gold around the world, most central banks around the world hold gold as part of their reserve asset management portfolio. And a lot of the family offices hold gold. So there's something in gold that preserves the wealth of nations and also of families and institutions. But looking specifically in Malaysia, at some of the Malaysian investment market and people playing in the investment market, there are a few realities. If you have a diversified portfolio, you have your high risk, high return assets, and you also have your low risk, low return assets. Within the Malaysian context, one of the biggest challenges is what do you use for your risk-free asset? If you're an American investor, you invest in US tips. If you're in Japan, you invest in JGBs, and in Singapore, you can invest in Singapore government securities. But in Malaysia, you don't really have that. I mean, you can potentially, if you have a lot of money, invest in Malaysian government securities, but typically it's anything $250,000 ringgit to $500,000 ringgit. So what do you use as the alternative for a risk-free asset? Do you want a truly diversified portfolio? And in that sense, I think gold plays an important role in a fully functioning balanced portfolio for people to take on whatever risk allocation they want, but they need to have gold in that. Over and above that, gold has specific roles as played time and time again, which is that it's a hedge against inflation, is a hedge against currency risk. So when there's weakness in the ringgit, then gold tends to pop up. And we've seen this happen even when gold depreciated against the US dollar 3-4 years ago, it actually appreciated against the ringgit. And last but not least, in these times, gold really comes to its fore because under normal market conditions, gold tends to have an uncorrelated effect relative to the rest of the portfolio. But at times of extreme stress, when your perfectly diversified portfolio becomes positively correlated, gold tends to be negatively correlated. So you can, liquidate your gold to fund your losses in other parts of your portfolio.
Okay, we're going to come back about the correlation between different asset classes. But Rajen, do you agree with Robin? Are you a gold bear or a fan, a gold bug? Because what worries me is the simple logic that what goes up must come down, right? So gold has risen by more than 50%, 50, since 2015. So is there a risk this will all come crashing down? So not only is it not preserving my wealth, but actually might cost me losses.
Sterling, hi. My view is a little bit different. I wouldn't look at gold as a consistent preserver of wealth. I do think, however, that given mankind's love affair with gold for at least 5,000 years, it's not going to change. I think gold has the ability to be incredibly volatile in US dollar terms, which is the de facto global currency. So right now, gold is slightly over 1,800 US dollars per ounce. The all-time high was August 2011. It was $1,917.19, apparently. So when you look at the risk-reward relationship of different asset classes, one of the things you must understand is that in investment science, when you talk about risk, it's not the same as the same kind of risk that you would take, let's say, if you were unwise enough to try and cross the federal highway when the traffic's actually flowing. When it comes to investment science, risk refers specifically to the statistical quantity of standard deviation, how much spread is there. And so I've been around long enough to have seen gold prices rise and fall, and I'll go into that later if you like. But I think the allure of gold will continue. I believe gold's price will rise and it could come crashing down. But I actually see that as a positive, not a negative. Because I think it'll give you the opportunity, if you take a 10-year view, 20-year view, 30-year view, 40-year view as an investor, if gold always has a place, it may be a tiny place, but a place in your overall portfolio, then if you actually dollar cost average your gold exposure, I think you will end up doing very well. So I'm coming at it from a very different angle from Robin's, but I'm not anti-gold. I would like to see gold used more and more for industrial uses, because ultimately when it comes to commodities, my view is commodities are the stuff of life, be they soft commodities or hard commodities. And the more useful any commodity may be, for instance, when you talk about platinum, palladium, what's the other one? Rhodium. Rhodium is like the most expensive non-radioactive metal on Earth, but there's no real market for it because I think there's so little of it. So when we talk about precious metals, most of us think of gold and silver, but there's also platinum and palladium. Ultimately, I guess it's the way I'm wired. If I can't use the stuff, I don't really see the value. But even from an industrial perspective, I think, and I believe Robin can speak more on this later, from an industrial perspective, the uses of gold will rise as well. So that, I think, augurs well for it.
And Robin, what do you think about gold prices currently? Do you see more upside? I mean, isn't the ultra low yield environment already in gold's price today?
Well, I think you can look at gold through different lenses, right? In the long run, gold typically rises around the rate of inflation in local currency terms. I mean, people always talk about US dollar when they reference gold prices, but the reality is, within the Malaysian context, very few Malaysians are in a position where they look at their portfolio in US dollar terms. They look at their portfolio in Malaysian ringgit terms. So, in Malaysian ringgit terms, gold typically has risen on an annualized basis in the long run around 7% per annum. Now, it will fluctuate up and down. It can crash. It can overshoot on the upside, but in the long run, it's 7%. Specifically now and over the next 10 to 20 years, if you look at the behavior of central banks and specifically China, if you look at how much gold they've been accumulating and also their intent, they're one of the few countries that actually has a national gold strategy. And then you look at how much gold they hold as a percentage of their foreign reserves and then benchmark that against what typically central banks hold. If they were to just go to the average of the world, that's about 10%. If they were to accumulate gold to get to that 10%, they would need to buy every single ounce that is produced for the next 2 years. If they wanted to become to benchmark themselves against the top 10 holders of gold, they would have to buy every single ounce of gold that will be produced for the next 5 years. And just to extend that a little bit more, if they were to only just buy 20% of the amount of gold that is produced, which is typically what central banks buy in totality around the world, you're talking about 4 or 5 decades. So in the long run, it's an inflation hedge. In the kind of like the medium-term long run, you have the China play. And specifically within the next 24 months, it's a function of your view of the world that we live in. If your view is that there will be less uncertainty, then there's every chance that gold will correct. If your view is that there will be a prolonged or increased uncertainty in the world, then the chances of upside will persist.
Okay, let's bring this back to a Malaysian perspective, right? Because we know gold is traded in US dollar, but there's this view that in the longer term, US dollar is going to depreciate, right? Just on the basis that they're just printing so much of it. So if I continue to hold gold assets, which are in US dollar, and the US dollar depreciates, my net wealth will also decline. So, doesn't make sense, or it doesn't hold true that theory, right? Gold as a preservation tool. What do you think, Robin?
Yes and no. I mean, I get that, but the problem is with currencies is that it's a pretty complicated set of attributes that drive the relationship between ringgit and the US dollar, right? Historically, when US dollar has weakened, yes, the ringgit can also increase, all things being equal, but things are never equal, right? You have your domestic situation, domestic politics, domestic economic situation. So depending on your view of where we are at a given point in time, you might well be right. Gold may fall in value, but if your view of the local situation within Malaysia, within ASEAN, is of a different mindset, then no, I would say that gold doesn't necessarily have to weaken. It can, in fact, strengthen, which is exactly what happened, 3-4 years ago when gold depreciated against the US dollar, but increased against the Malaysian ringgit.
And Rajen, don't you have this sense that the world has gone slightly crazy from an investment perspective? Because, I mean, investment theory is such that equity goes up, gold should actually go up. But it seems like every asset class is on the rise in this post-COVID-19 era with this ultra interest lower environment. So how should we view gold when you compare it with the different asset classes that we are familiar with?
Ning, I want to deal with what you're talking about, the fact that the asset classes seem to be moving in the same direction, that the correlation seems to be one. Now, typically what happens in a deep crisis is that you throw out your textbooks when it comes to investment science with regard to diversification, because what you typically want to do is to fill your portfolio with asset classes that are negatively correlated. When one zigs, the other one zags. But in every single deep crisis, correlations go to one. So you've got to ask yourself, why is it stock prices are rising at the same time that gold prices are rising? And pure logic, you don't need to be an economist to work this out. Over the next 30 years, the global population is going to grow from the current 7.7 billion people to maybe about 9.5, 9.6 billion. So very roughly, maybe up by about 25%. If you look at the behavior of the concerted behavior of central banks during the global financial crisis, and then certainly in the last few months, you find that it is completely possible for the world's money supply to increase by 10% or 20% in a single year. Now, if over 30 years, the global population is going to grow only by 25%, but the amount of money that we have chasing all this stuff is going to astronomically just balloon, then clearly hyperinflation should take place. And yet when we look around, we don't see hyperinflation. We see deflation in the computer sector. We see prices coming down. Yes, if you go to a Malaysian market and you try and buy vegetables or you try and buy fish, it gets very painful, but it's not hyperinflation. It's just kind of high inflation. And there are other things where the prices come down. But what's effectively happening is high inflation is occurring, but it's all that's extra money is going into the investment assets. And so around the world, investors are looking for yield. What I don't like about gold or any other precious metal is that there is no yield. So that's why it's not my favorite asset class. However, I do believe that, and I'm just guessing here, that over the next 10 or 15 years, I wouldn't be the least bit surprised if gold oscillates between 1,000 US and 3,000 US dollars. And so I go back to what I was saying, that the dollar cost averaging will actually work. Normally, when you talk about investments, your goal is to increase your total returns. And your total returns comprise two portions. One would be capital gains, and the other one is yield. Now, since gold gives zero yield, if you're going to take advantage of it, it has to be all capital gains. And if you take a long-term view, and if you consistently add to your gold position, Robin actually said something that hit the nail on the head earlier. He said that anytime things start to dip, and if your gold is doing well, you can actually liquidate and you can actually make up the portfolio difference. And what I like to do is during periods when gold prices are high, remember, I don't like the fact that there is no yield. But if the prices are high, and I think that these are super normal profits that you can actually take, I would be inclined to actually slice off, turn that to cash, and then move into more productive assets. In the long run, and within the span of a human lifetime, long run basically means throughout your working career until the time that you actually retire. When you get into retirement, what we need is yield. And for regular people, the yield that we're talking about is the interest that we earn from our bank deposits. It's the dividends that we get from our income producing stocks. It's the rental that we generate from our properties, rental properties. It's the distributions that you might get, the cash distributions that you might get from your mutual fund or your unit trust portfolios. So ultimately, as you get old, what you want is to be able to see money coming in so you calm down. But Malaysia is still a young population. And as a result of that, our people have a long time to invest. And so I think gold really does play a role. I'm not worried about the fact that prices will come down. I may have got slightly off tangent, but hopefully what I've said is of use to listeners. Did you want to ask me anything else that I didn't deal with just now?
I'll come back to you in a minute, but Robin, I want you to address this question about yield, because I mean, this point about it being a non-productive asset is something that Warren Buffett has said countless times, right? He doesn't like it. He prefers stocks. He even prefers farmland. Now, Robin, we know you went to Oxford and studied classics, so clearly highly intelligent. But doesn't Warren Buffett have valid point? I mean, after all, there is a compounding effect of yield, which, you know, you can't underestimate. Yeah, and gold doesn't have that.
Yeah, I was a very, very bad student at university. So so one of the issues with gold, and it's absolutely true, because it's very hard to construct a valuation model for gold. I mean, many people far more sophisticated and intelligent than me have tried, and at best, my view is it's a guesstimate. Having said that, the tragedy about the financial markets is that there are many products that exist, but not all products are available to everyone. So between central banks and between bullion banks, there are gold products that create yield with physical gold behind it. Gold leasing products that banks will lease to fabricators and manufacturers, and there's a yield behind that. But that's typically not available to the mass affluent, the wealth management space. It might be available to the private banking space, but it's definitely available to the mass retail space. And that's a big challenge. So gold does have, you can create a product with yield with gold in it that is relatively safe. You do take some credit risk, obviously, because there's no such thing as low risk and high return. But it is possible to do that. It's just that that's not widely available to the broader market.
Yes, Malek Ali.
Here's a question from Facebook. I think a lady called Yvonne Kong says, normally the US market in gold goes up. Normally the US market and gold, like I think she's talking about the US equities market, and gold goes in the opposite direction as investors look for safe havens. How do you see the current situation now where both the US market and gold are both, sort of in this sort of record levels territory, or at least for the technology stocks and so on? You talked about correlation, right? So before there was, I think she's implying that before there might be some opposite correlation, negative correlation. Now they're both in positive correlation. What can you have? Do you have an explanation for that?
How long can it last?
Are you asking me?
Whom are you asking?
Rajen, why don't we start with you?
Okay, I'll keep this short. It was Alan Greenspan who borrowed someone else's phrase and then pretty much made it his own when he talked about irrational exuberance. I think if we actually look at the cratering of the real economy caused by the COVID-19 pandemic, the kind of equity price levels we're looking at right now are utterly irrational. And I think ultimately things are going to come crashing down. That is one of the reasons why for pretty much all of my financial planning clients, for those for whom I manage a portfolio, I'm holding very, very high levels of cash. And I'm ruining the day right now because everyone who's gone risk on is basically way ahead of me. But I just have this really bad feeling. I'm waiting for the next shoe to drop. And so Yvonne's question is a very intelligent question. I think if we get to the point where asset classes, if stock prices go so far beyond fundamentals that people will one day wake up and say, you know, I think we've really pushed this too far, then I think there's going to be a tremendous drop. I got to tell you, if you look at the fact that yesterday's news, Elon Musk overtook Warren Buffett as possibly maybe the 7th wealthiest man in the world. And I think it's great. In the pre-discussion we had, Robin was talking about Star Trek, and I'm quite a hardcore Star Trek fan. But the best thing I think about Elon Musk is the fact that he actually has real aspirations to go to Mars. And I'm going to bring this back to Earth. Right now, Musk is sitting on supernormal profit because of irrational valuations. Now, if he is able to really monetize a portion of that and actually plow that into space research, and if as a result of the work he does 30 years from now, we actually end up with businesses that are mining the asteroid belt, then that's real benefit to planet Earth. But at the moment, a lot of this is fluff. And what I'm worried about is this really reminds me of 1999 in the build-up to the dot-com bubble when things came crashing down. The NASDAQ collapsed by about 2/3. If I remember correctly, from about maybe, was it 5,000 points down to 2007? I'm using my memory, so I'm not too sure. But that collapse happened in March of 2000. And so what we're seeing now reminds me quite terrifyingly of 1999. So I am worried. I think if the US stock market does collapse, I think gold is actually going to end up doing better because there will be an even greater sense of fear. And then the flight to safety portion will actually kick in. So that's my perspective.
If I'm allowed, so just another question from Facebook. This is Ilham, and I think it goes around the same questions, right? He goes, gold or stocks, we talked about, do they both correlate together? But I think in his perspective, I guess that he also expects that correlation not to hold, as what you hinted at. But is between gold and stocks as a wealth preservation tool? His question is, I'm thinking if I invest in stocks, also the wealth preservation tool as well. Which one should you choose as a wealth preservation tool, stocks or gold?
Whom are you asking?
I'm asking Robin, sorry.
Well, I mean, look, I think people, most of us are in the wealth creation phase of our life. We're not fortunate enough to be in the wealth preservation phase. And most of us look to the stock markets to make supernormal profits, right? To beat what we get from EPF, PNB, etc. So absolutely, stock markets is where you try and create wealth. And gold should be seen as your hedge, a pretty easy to use hedge that is readily available in its various investment forms for you to manage the downside risk. If I may, just to add to the irrational exuberance, back in 2014, anecdotally, 2013, I was at the Milken Institute conference on the West Coast, and we had a sitting Fed Reserve governor in a closed door session. And he was asked at that point in time about quantitative easing, which is effectively what's happening now. And someone asked him, where is all this going to end? And this was a sitting governor. And he said, I don't know, I just hope it'll end well. And if you talk to most economists around the world, I ask them, how does this work? And it's a grand experiment. And I think that's the greatest concern for most people who kind of have worked in the financial markets, is that we're now kind of in uncharted territory when things that you expect to happen no longer seem to happen. And the view is that, everything reverts to the mean at some point in time.
I mean, there's this eternal question, right, that we've been in this ultra low rate environment since 2008. Is quantitative easing continuing forever and ever? Interest rates are almost barely, zero. So yeah, the world is the investment world of the world has gone almost slightly crazy. And this is a question we keep on getting asked in the morning. There seems to be, like what Rajen says, a huge disconnect between Main and Wall Street. And I don't think anyone really has an answer how long this will continue, although everyone says it's just very much, the Fed printing money. But in the meantime, for those who just joined us this evening on BFM, we are asking an important question. Is gold a wealth preservation tool? And to help us answer this question, is Robin Lee, CEO and founder of HelloGold, and Rajen Devadason, CEO of RD Wealth Creation, and my partner tonight is Malek Ali, founder of Five Lie and BFM. Now, gentlemen, I want to go on to this concept of if you really want to buy gold and you thought of it and you think, okay, this theory makes sense. It is a wealth preservation tool. How should I go about it? Because in the past, it's always been seen as something that only the ultra high net worth can do. You know, I have to be super rich to buy it. So Robin, how would you go about it? I mean, how can the ordinary guy have access to gold? And this is your chance to plug a little bit of HelloGold, a quick one.
Quick one. So look, I mean, depending on how much you have, you have many different ways to access pure gold, right? If you have $10,000 to $50,000, $100,000, then actually just buy the ETF, right? The GLD, which is the world's largest gold ETF, is cross-listed on SGX, so you can buy that. And even in Malaysia, there is a gold-backed ETF now, so you can buy those. If you have less to spend, then the banks, companies like HelloGold have gold investment products where you can get exposure to gold and it's fully backed. The gold sits in a vault. The value that HelloGold brings to the table in Malaysia is that so long as you have a mobile phone and you can afford a nasi lemak, you can start saving in gold for RM1. So literally, there is no reason not to start saving in gold. So we bring the level of gold savings to everyone effectively.
And your transaction fees, are they reasonable? Because every company has to make money.
Yeah, sure. So our transaction fees are reasonable for the not so fortunate. They're pretty expensive for those that can afford private bankers.
What about you, Rajen? How do you advise clients if they want to buy gold? How should they access this precious metal?
Let me tell you a horror story first. And actually, that is my my reason for being here. Apparently, this story I told about my block of silver is why Malek decided to get me on a gold talk. A few years ago, my home was burgled twice in the same year. And the second time around, prior to that, I had actually gone through a silver phase. And I bought a block of silver. I didn't buy gold. Gold's about 100 times more expensive than silver. Right now, gold's at 1,800. I think silver's probably at $19 an ounce. But I bought a block of silver. I paid, I think, probably a 30 or 40% excess above the wholesale price of gold because the retail stuff was far more expensive. But I figured, no problems. I mean, silver is an industrial metal, and 90% of the silver that's ever been brought up off the ground, out of the ground, no longer exists because we've consumed the silver in our industrial processes. But pretty much all the gold that we've ever brought out of the ground is still there. I mean, some of it gets used, but not very much. So the second time they robbed my house, they took this block of silver, and so I've been ruining the day ever since, and I've been trying to get my money's worth just telling the story time and time again. So I actually tell the story to my clients as well, if it's appropriate. I do explain to my clients, and I tend to take a macro view, that it makes sense to have as much diversification as you possibly can. If you are a new client coming to me, I would basically say, don't put all your eggs in one basket. My mother taught me that when I was probably in kindergarten, and it is still true. We diversify, and I recommend that people diversify across 3 dimensions. You diversify across asset classes, you diversify across geographic regions, and you diversify across a long timeline. You either use dollar cost averaging or value cost averaging to diversify. When it comes to diversifying across different asset classes, the annual World Wealth Report does an analysis, not every year, but most years, and it basically looks at the world's wealthiest, maybe 20 or 30 million people, those who are able to invest $1 million US or more in financial products. And the 5 asset classes are cash, fixed income, equities, investment real estate, and alternative investments. Within the alternative investment space, you've got different buckets. Those include hedge funds, structured products, private equity, foreign currency, maybe a couple of other things. My favorite is actually commodities, because commodities represent the stuff of life. Within commodities, you can choose hard commodities, soft commodities, etc. When it comes to the precious metals within the commodity space, the four that you can actually buy are platinum, palladium, silver, and gold. Gold is the one with the greatest allure. So when my clients come to me and say, Rajan, I would like gold exposure, or sometimes they come to me and they haven't done this in a while. They say, I want oil exposure. It doesn't matter what commodity. All I will tell them is that I don't have anything that's very, very specific, but I can put you into a global commodity fund. My principal company is Manulife Investment Management, and Manulife is global, and this particular global commodity fund is managed out of Boston. So if you want global stuff, yeah, it's a very blunt weapon, but if you want that, that's what I do for my clients. When they say that they actually want specific gold exposure, I tell them also what I do. I have, with Public Bank, I have a paper gold account. So as in when because the price has actually gone up, and with the COVID-19 crisis, my business income on a month-to-month basis over the last 4 months has plummeted 71%. So yeah, sometimes I've actually got to go sell my gold, to be able to balance the budget, etc. But that's why it's there. I don't own my gold to generate a yield. I own my gold, and I explain this to my clients as well, so that when you have a situation where you've got excess money and the gold price is low, look, if you're going to be an investor for 20 or 30 years, eventually gold's price will rise. But at this time, when gold prices are high and perhaps you're actually going through a tough time, maybe now's the time for you to actually harness some of that excess money. So the exposure that I grant my clients for commodities in general, and once you drill it down in a very, very defined manner, is very much paper-based. I learned my lesson about the dangers of having physical metal.
So there is a question from Facebook on specifically for Robin here, and I think because it's about is about holding cost.
Mm-hmm.
If someone were to park and invest, buy gold through the HelloGold platform, what is holding cost for keeping, keeping the gold inside the HelloGold platform?
So roughly, it's about 2% per annum.
Okay.
For storing and insuring and auditing the gold, and we charge, it's amortized on a daily basis and charged on a monthly basis. So it's rough. I mean, the math is 2% divided by 365.
Okay, and then the other point is, I think so just a point of confirmation, is your spread lower than buying gold from the banks?
It depends. So we benchmark on a kind of daily, weekly basis, and generally we are there or thereabouts. Some days we're cheaper, some days we're more expensive, but we try to be the cheapest product around for our target market.
Okay, got it. All right. Okay, over to you, Shou.
And Robin, a question, right? You say the annual management fees is about 2% per annum, which is slightly higher than a normal unit trust, which in Malaysia is 1.5%, right? Mm-hmm. So I'm just curious, if you really want gold exposure, how about buying gold stocks or gold miners?
Yeah. So actually, a lot of people typically, when they want gold exposure, particularly if they're in the mass affluent wealth management space, they will typically buy mining stocks. I'm not a wealth manager, so this is just my personal opinion. I prefer to buy, if I were to buy mining stocks and basically have a leverage play on gold, I prefer to buy streaming companies or royalty companies rather than pure play mining companies, because streaming companies, I think, give you all the leverage of gold without none of the operational issues. So that is one way to get exposure on gold, and there are a few that are well known and have done spectacularly well. I'm not a huge fan of mining stocks, because every time I used to work with my last company, I talked to them, the mining CEOs, and they're always is boom or bust for them.
Rajan, do you have a view on gold stocks? I mean, names like Newmont, Barrick, they've gone up quite a lot this year on the back of this gold rush, I would say. Is it very, I mean, there are, of course, risks. But if you're a big, why not buy that instead? Because the transaction cost is very low. It's just a normal stock transaction.
Yeah, I definitely wouldn't buy mining stocks right now. My view is that at some stage, gold prices will fall. when gold prices fall, the mining stock prices are going to overcompensate. The way to make money is to basically buy low and sell high. And actually, you want to talk about real gold in the Malaysian context right now, it's rubber, specifically rubber gloves. That's pure gold. And I remember during the SARS crisis, I remember telling myself, okay, rubber gloves, far too expensive. What I need to do is just wait for things to normalize and then gradually accumulate. Of course, I forgot my own really good advice and I didn't do it. And I'm certainly not going to chase after the rubber glove companies now. But next cycle, they're going on record now. I'm going to try and remember to buy the rubber gloves when nobody wants them. So I wouldn't buy mining stocks now. They are cyclical. I would buy them later on when gold prices are basically at near-term, well, I guess midterm lows. Remember I mentioned just now that I think, and I'm merely guessing, and I'm no expert in this regard, I'm just looking at the price range. I think it is fair to assume that over the next 1.5 decades, the gold price is going to oscillate between 1,000 US and 3,000 US dollars per ounce. I have absolutely no basis for this. I'm just making this up. But if I'm right, then at least I have a planning range. And as the gold price drops closer to that 1,000 mark, my interest in accumulating actual gold, probably not physical gold, I've learned my lesson with physical silver, but paper gold and maybe mining stocks will increase. And then later on, when things change and gold price rises again, I need to remember to actually start selling. You must, when it comes to cyclical stocks, you must actually take a trader's perspective. My personal temperament is actually to buy and hold. I would much rather just buy something and hold it for decades. But the truth of the matter is that you can't do that for every single element of your portfolio. And that's where dynamic asset reallocation takes place, comes into its own.
Now, gentlemen, another theory that I've seen increasingly being circulated is the fact that some argue that Bitcoin is the new digital gold. So, Robin, this question is for you. I mean, it's more liquid, it's more tradable, and some would say an even better hedge against governments around the world printing money, since there's a finite amount, right? There's only supposed to be something like 21 million Bitcoins out there, and only 18 million have been minted. So, what do you think about this new view?
When you
Is it
say
going to
more
challenge gold?
when you say more tradable, more liquid, are you saying relative to gold?
Well, there's that theory, right? Because you can go online, you can buy it. People think it's easy to do. Doesn't seem so formidable versus buying gold.
Well, so just put in perspective, right? Gold's liquidity is, I can't remember, right, it's third or fourth in terms of a product or instrument after US Treasuries, JGBs, and German bonds. So it's a very deep and liquid market. And in the great financial crisis in 2008, when everything crunched up, gold was trading normally. In fact, this crisis was the one time when physical gold trading started to crunch up, because you couldn't move the metal around because there were no flights. So they couldn't put metals on planes. They couldn't bring unrefined gold to the refinery to process. There was no one working in the refinery. So it was the first time that, at least that I can remember, that the gold market was in stress. Now, going back to Bitcoin, yes, there is a narrative where, Bitcoin can become the new gold, and asset classes and new instruments become normalized over time. I remember when I first started working, hedge funds were kind of a marginal play, real estate was a marginal play, but now they're accepted part of the investment portfolio. So there is every chance that Bitcoin can do that. I mean, you're starting to see that now at the margin in the North American and European marketplace. But for it to replace gold in its fullest extent, it would, once governments start to replace their gold reserves with Bitcoin, then yes, that may well happen. But I don't see that happening anytime soon, because governments are kind of conservative in the wealth preservation space. They're not in, and they tend to like boring products, right? Relatively low risk, relatively low return products, and Bitcoin is high risk, high return, and they're not in that space. So when Bitcoin becomes boring, then I think it can happen, but I don't think it's going to happen anytime soon.
What about you, Rajan? Do you think Bitcoin is an alternative to gold, a worthy successor one day?
No, I don't. Generally speaking, old people buy gold, younger people buy Bitcoin. You follow time's arrow, the old people will die off, and the young people will become old. I don't think the correct comparison is gold, physical gold or paper gold, and Bitcoin. I think the correct comparison is, will cryptocurrency, whether it be Bitcoin or any other worthy crypto, will it actually replace real currency, US dollars, the euro, the Japanese yen, for us, the ringgit, Singapore dollar? And my view is no. I don't think sovereign governments will allow that. You think about the whole process of creating cryptocurrency. The mining, interesting term they use. The mining is actually done on computer networks. Certainly with Bitcoin, it uses tremendous amounts of power. I think that the greatest tool that sovereign governments have is their ability to create money out of thin air, the printing of fiat currency. If you consider conventional understanding of economics, humanity basically went from barter trade to, let's disregard the seashells and the furs and bits of tobacco, and we basically went to commodity money. It's called commodity money because it was little bits of silver and gold. The money itself was valuable. And then there was a transition from commodity money to representative money. And I think the Chinese were the first to come up with paper money. And technically the way representative money worked was you would take that piece of paper and you would go to your central bank or de facto central bank and you would say, I give you this piece of paper and please give me a few pounds of silver or a few ounces of gold. That was the trade. And then, lots of things have happened, but as far as we are concerned, the most important event in reasonably recent history was March 1971, when Richard Nixon, before the impeachment, Richard Nixon basically broke the gold standard. For decades prior to that, gold had been running at $35 per ounce. And once the gold standard broke, it stayed at 35 for a bit, and then it started to escalate very, very quickly. The other interesting thing is that when the gold standard was broken, finally Americans were allowed to own gold. I mean, you talk about, the land of the home of the brave and the land of the free. It's insane that by government edict for decades prior to that, it was illegal for Americans to own gold. So suddenly when Americans were able to buy gold, they did. And the price went very quickly from $35 an ounce to $100 an ounce. And so the rest of the world started selling to the Americans because the Americans wanted to buy, and it was excessively priced, and the price collapsed. So as far as I am concerned, I think that the ability to go from, governments went from representative money. When the gold standard broke, it became fiat money, effectively backed only by the confidence in the issuing government. And ever since that happened, every single country only issues fiat currency. I don't think any government is ever going to willingly give up that power. So I think if governments need to come down hard, they can actually make a particular cryptocurrency illegal. They can shut down the servers where the mining takes place. They can cut off the electricity supply. I am very dubious about crypto, so I would say no.
There's a question on Facebook here, Rajan, for you, and I guess, Robin, if you know this question, I'm not sure whether you have the data on hand. If not, maybe I can ask one of our teams just to do a quick check. Between silver and gold, how have they performed over the last 10 years? This is by Frank Ng, and also the outlook. So does anyone know, do we know how have they performed relative to each other over the last 10 years?
I know for 1 year. For 1 year, gold is up, but this is against June last year. It's up 26%, while silver is only up 21%.
Okay.
So I think historically, people have bought silver. Go back a bit. Well, one of the big challenges between silver and gold is that most central banks buy gold, and very few central banks, if any, buy silver. Sovereign wealth funds are the same. Everyone just buys gold. Silver historically has been very popular for something that Rajen sort of alluded to, right? Because it's significantly cheaper. You can buy a silver coin for much less than you buy a gold coin. But with technology today, with ETFs or with something like HelloGold, you don't have to buy the coin. So you can just buy whatever you can afford, and you have fractional ownership of the bar. So it doesn't really matter so much. I think and so that's one aspect. The second aspect is that there is a ratio between silver and gold that everyone tracks. When gold overshoots, if the ratio overshoots to one side, then people start to buy silver, and it overshoots the other side, it's kind of start to sell silver. In terms of that ratio. Now, the reality is that if you look at most vaults, in terms of value, gold typically has about 3/4 of the value in a vault, but silver occupies much more space. So, if you buy the equivalent, the financial institutional size for a gold bar, which is like the gold finger 400-ounce bar, which is about $400,000. It's basically the size of a brick. If you were to buy the equivalent of a silver bar, which is going to be worth about $30,000-$40,000, it's like a traffic stop. It's like a brick to stop people from running over you. So it's much bigger, much more expensive to vault.
I do have some data if you'd like to hear that. Right now with gold at 1800 US and the all-time high, if we go back 9 years, at 1917, which is what I mentioned earlier. I'm doing this in my head, but it seems to me like gold is within 5 or 6% of its all-time high. That's not to say it can't go beyond that, but if you're talking about trading bands, gold is very, very near its all-time high. In contrast, silver right now is $19 US, and its all-time high was 48.70 in the late 1970s. So if you're just playing with bands, I would imagine, and also the fact that silver is used far more as an industrial product, if there is any reason for silver for there to be a silver crunch, then I think the price can actually spike enormously because it's inherently, on a per unit basis, much cheaper. But perhaps the greatest investor of all time, Warren Buffett, actually committed $1 billion to silver. And then after a few years, he got really irritated when people started asking him about it because it was a wrong move in his from his perspective. So if the simple question was relative trading, then just looking at current price against all-time high, silver seems to have a lot more room to go. But I think in terms of ongoing allure, the allure of gold is literally the allure of gold. The moment all of humanity stops saying, we think gold is fabulous, and we all stop focusing on it, its price is going to come down to perhaps maybe even a base metal, who knows? But that's never going to happen. It hasn't happened in 5,000 years, and it's unlikely to ever happen. So in terms of safety of investments, if you have a choice buying silver and gold, I would say buy gold. But if you want to do a speculative trade over, let's say, a 2-year period, then what you want to do is to look at what all commodity traders do. Look at your specific commodity, look at the supply and demand curve, and if you can anticipate better than most other people that an upcoming crunch is on the horizon, then what you want to do is to position yourself. Unfortunately, as far as that's concerned, I don't know what the crunch might be, whether it be silver or gold or something else. But given my predisposition, if I had to put down 1,000 ringgit on silver or 1,000 ringgit on gold, personally, I would put it in gold right now.
Okay. How would so I guess a question here from so the question is about how do you get exposure to silver other than your sort of buying a silver bars, Rajen? How do you get exposure to silver?
I have no idea. Obviously, that's why I bought a silver bar. So I think Robin will be able to tell us.
I think there's another question where basically, is there any time in the future that you might do a Hello Silver, or at least a silver account in your gold app? That's a real question, actually.
So, so the answer to the HelloGold thing is yes, we're looking at it. I think we're going to launch some other products before we launch the silver product. There are ways in which you get exposure to silver beyond buying the metal, the borrowing point. There are silver ETFs out there, but the largest one I think is a BlackRock product. I think you have to buy it on the New York Stock Exchange. I don't think it's cross-listed anywhere. You can also buy through certain banks silver investment products as well, but typically the storage costs are much higher because it's much bigger.
Great. Shou?
Yeah, thank you very much for this. On this note, thank you for your time today, gentlemen. Today joining us to answer the question, is gold a wealth preservation tool, was Robin Lee, CEO and co-founder of HelloGold, and Rajen Devadason, CEO of WealthCreation.
Yeah.
I think Malek has something to say.
Yeah, that's right. Even though we were talking about Robin sacrificing some margins, in terms of his holding costs, 5 times his holding costs, as well as so maybe a couple of transactions. He's giving basically for every, no, not for every, but for your first 100 ringgit investment, if you were to partake in this gold investment, use the discount code HELLOFI, HELLOFI, and he'll give you an extra 10 ringgit worth of gold, at least for the first 100 lah. We can't expect him to give for the first 10,000. Then it'll be quite difficult for him. But at least for the first 100, get another 10 ringgit of gold extra for that. So Robin, thank you very much for giving BFM webinar guests that small token of appreciation. Appreciate it. Thank you very much. Shou?
Yeah, meanwhile, on the topic of webinars, the next one will be on the 17th of July, this Friday at 12 p.m. Also, of course, on Facebook. It's a special health and living weekly webinar, Overhaul Your Health, that's the title, a post-pandemic guide. It's going to be presented by AIA, brought to you by BFM. Our moderator, of course, is going to be Mira Sivasodi, presenter of Health and Living and the calming voice of BFM, I call her. Speakers include Dr. Winnie Chi Su Sui, who is the Professor, Department of Nutrition and Dietetics at the International Medical University, and Dr. Yeo Wee Kian, Director of Research and Innovation at the National Sports Institute. So do tune in. In the meantime, may I please ask all who are watching this live on another date to complete the feedback form posted in the comments section. We really would like to know what you think. And of course, do listen to us live every day or to any of our podcasts, which are available on the BFM app or on Spotify. I'm Shou Ning, signing off together with my partner in crime this evening, Malek Ali, co-founder of filife and of course BFM 89.9.